Hello everyone, welcome to Commerce classes, and today we'll be working for adjustments of normal and abnormal losses of stocks under perpetual system. As we all know that in case of perpetual system, we prepare a stock ledger recording stock ins, stock in outs and the updation of the stock balance with each transaction. So within that statement, the adjustment of normal and abnormal stocks will be like this. Number one, for the normal losses. As we all know that the normal losses are not valued, rather they are absorbed in the closing balance of inventories. Since in the stock ledgers, in case you remember, in the stock ledgers you have stock in, stock out column, and then a final column of balance. So every time the balancing figure is recorded as the closing balance. So we'll measure stock out, we'll record stock in, and if any normal loss is there, it will be absorbed here in the balance. So while recording the balance, normal loss will reduce the quantity, but the amount will remain same. So that amount will be absorbed in the given quantity. So how do we do this? We enter normal loss in the stock out column. Okay, so it will be recorded, but it won't be valued. There is no cost associated with this. Okay, now in the balance column, reduce the number of units from the relevant lot and keep the cost same. So cost will remain same, thereby increasing cost per unit. So your revised cost per unit will be available cost of the lot divided by number of units available, that is closing stock minus normal loss. So if you have say a quantity shown in the books, say 800 units, but out of 800 units if 50 units are lost, then the whole cost of 800 units will now be spread over the 750 units. However, in case of abnormal loss, what will happen, that we will be valuing it. So these are valued just like any stock issue. So the way in which we measure stock issues, in the same manner, be it FIFO, LIFO or wave method, the abnormal loss of the stock will be measured. So we'll enter abnormal loss in stock out column with cost associated as per the method. Now in the balance column, reduce the number of units from the relevant lot as well as price it according to the system. So our closing balance or the cost of the closing balance will also be reduced. So accordingly, closing stock will be determined. So let us understand its working with the help of a question. So this is our question which we'll be solving for all the methods, that is FIFO, LIFO and wave. One question is there. We have the balance given to us. We have the purchase issue, purchase shortage means a normal loss. Then you have again issue, purchase, and then you have abnormal loss, that is loss by theft. So when we are recording this shortage, that is 100 units of loss, then we won't measure it. We'll simply reduce the number of units in the balance. Cost will be spread. But when we record this loss, we'll be measuring it just like any stock issue. So let us consider this. So first of all, in this stock ledger, we'll be recording the balance. We know that balance comes here. Till now, you are aware of the complete principle of preparing the stock ledger. Then we have another transaction, purchase. Now, whenever we have purchase or stock ins, they are just added to the given lot. So we have one more lot in our row. So herein in the balance, you will be recording the balance of 500 units. Then it will be followed by the next 1000 units that we have purchased. Okay, so in the balance, we'll be having 500 units and 1000 units next lot, because in FIFO and LIFO, the lots are identified separately. Had it been say a weighted average method, in that case we would have combined everything. So herein in place of this 1000 and 1500 units, we must be having in all 1500 units and a total cost of 47,000. So accordingly, weighted average price would have been calculated. Anyhow, now when you issue 600 units, then as per FIFO method, our first lot is of 500 units, so that will be utilized fully. This lot will be fully utilized, and then this second lot will be used for the balance of 100 units. So after this our balance will be, first lot is fully over, this lot has been fully used in the issue, and herein in the balance we'll be having remaining 900 units left with us, isn't it? Now let us take up the next transaction given to us. We have next transaction of purchase. Now purchase is taken as another lot. So herein, while recording the lots, we'll be having this lot of 900 units as it is, and then this lot will be following, and a second lot will be recorded after this lot. So you can very well see here you have two lots coming here. Now you see we have a shortage. Now shortage will be recorded in the stock out column because our stock is reducing, but it doesn't have a cost. We don't value it. So what will happen? This normal loss will be spread over the cost of the lot as per the method. If we are following FIFO approach, then FIFO approach says first in, first out. So presently this is our first lot. So this normal loss will be spread over this. So now we will be having number of units in this lot as 800, and our cost will be same 28,000. So cost will remain same, number of units will be reduced. However, had it been a case of LIFO, then last in first out will imply this loss will be adjusted. This loss will then be adjusted in the latest lot. But right now we are working for FIFO, so our first lot is reduced by the amount of normal loss, but see there is no change in the cost. The cost of the lot is same as it is, thereby increasing cost per unit. This is what we mean by spreading the cost over remaining units. This is the concept of this normal loss working. Now next we have issue. Now when you have an issue of 900 units here, then as per FIFO approach, this must be taken up from the first lot, and as our first lot is of 800 units, so you will utilize this lot, and then for the balance this second lot will be utilized. So just see, so we have 800 units of first lot fully over with this. So this lot is fully finished. Then from the next lot we have 100 units being issued. So can you see the balance here? So balance will now be comprising of, just pause for a minute and then you can consider this. This first lot is over. In the second lot we are issuing 100 units. It means 1900 units must be left. Let us see this. Yes, right. Again you issue 1100 units. Now whenever there is another issue, this must be out of the first lot available. So first lot is only one. So when you issue these 1100 units out of this available lot of 1900 units, so now you will be left with how many units here? 800 units. So you can see here 800 units are left. Then you have another purchase. Now whenever we have another purchase, then both under FIFO and LIFO approach, the new lot comes after the available lot. So this lot is already available, so after this you will be writing the next lot. So lots are ordered as per the time period when they enter into the stores. Now you have loss by theft. Now in case of abnormal losses like loss by theft, then these needs to be valued. So this loss must be recorded in the stock out column, and this should be valued according to the approach that you are following. If you are following first in first out approach, it will imply this abnormal loss will be from first lot. If we are following last in first out approach, it will be from the latest lot. And if we have weighted average method, in that case you will be finding that there is no lot here. You won't be having these two lots, rather these are clubbed together, as therein we will be having 1100 units at the price of 47,000 with a weighted average price, right? So therein it will be taken from that lot. So presently under FIFO system, so this is being measured at the cost of the initial lot, because this is our system first in first out. So abnormal loss is met out of first lot. So now you see out of this 800 units available here, 750 are lost. So we are left with the balance of 50 units here, and next lot is fully there. Then you issue 120 units again as per first in first out approach. First lot is fully absorbed. this first lot of 50 units is fully used for this sale, then the next sale of 70, because in all we are having 120 units being sold, so this will be taken from the next lot. So in a way, first lot is fully over. From this lot, 70 units are issued, thereby leaving 230 units. So this is our closing balance. So while solving this question in your exams, you can simply highlight this as closing balance. This is your closing stock. Now coming to total of purchases, this is your total purchases column, and total quantity purchase will be totaled up here. Now this column gives us usually the total quantity being issued and total cost of the quantity. But now with the adjustments coming here, this will not be taken as the won't be taken as the cost of goods sold, because when you totaled up this column included 30,000 rupees of abnormal loss. So if you separate this abnormal loss, you will be left with cost of goods sold. So your cost of goods sold will be 1,30,500 minus 30,000 abnormal loss that we have added here, and your closing stock will be 230 units at the price of 50 rupees each. Your abnormal loss is valued at 30,000 and normal loss is as it is. So this is how your final answer will appear. Now taking up the same problem under LIFO system. So your balances as it is, purchases are now recorded, so you have got 2 lots. Then you issue 600 units. Now remember, these units are being issued, these 600 units. So as per LIFO approach, you must utilize the latest lot first. So this sale will be happening from this lot. So you will be left with first lot fully, and out of this lot, since 600 are issued, so 400 will be left. So your pricing of the issue will be at the latest lot basis 32 rupees. So your balance will be first lot is fully there, second lot is 400 units. Then you purchase certain units. Now purchases are always taken as another lot. So this will be taken as a third lot. It implies now we have 3 lots in order. Now when you have shortage here, this shortage of given number of units, now this is involves spreading of the cost. But now which lot will be used for this purpose? Since we are following last in first out approach, so this lot will be having this spreading of the cost. So this normal loss will be affecting neither first or second lot but the latest lot as per the method. So what will happen? We'll write shortage, and these are not valued, so there is no price given. But when we record closing balance, you see now here in the latest lot, your quantity has reduced from 2000 to 1900 because of this normal loss, but the cost of the lot will remain same. Okay, so you have the same cost, that is 80,000 as you have here. Okay, cost is same, so this cost is now spread over remaining 1900 units. So this is what we call spreading of the normal cost over the other units. So now your price will change. Now when you issue 900 units as per LIFO approach, latest lot is used. So 900 units are done with, 1000 will be left from there, and initial 2 lots are still there with you. Another 1100 units. Now when you are to issue these 1100 units, then you are to utilize the latest lot. So latest lot available here is 1000, and then 100 from this lot will be used. So when you use completely your latest lot and 100 from this, you will be left with first lot completely, and from the second lot 300 units are left. Then again purchases are taken as another lot, so you have got 3 lots here. Now loss of stock by theft, this is abnormal loss, this needs to be valued. Now as per LIFO approach, this loss must be valued from the latest lot. So your latest lot of 300 units is now assumed to be lost. You now go to the next lot to complete the total loss of 750. So this will be used. So 600 are still done with, 150 is still left. So it means from this lot 150 units are considered to be the part of abnormal loss. So abnormal loss will be latest, next, and 150 units from here. So this is your abnormal loss. Now what will be the balance? Your last 2 lots are completely over by the abnormal loss. So these two lots are now completely finished. From this lot 150 units are lost, so you are left with 350 units at price of 30. Then you again issue 120 units. So as per the available information, you have just one lot available, so this lot will be used to issue the inventories right now. Okay, now you will be left with 230 units from here. Now you can total up the columns again when we calculate cost of goods sold. We are having this amount as the total of stock out, but this includes abnormal loss of 15,000. Okay, uh, 15,000 plus 9,600 plus this. So this will be 29,100 will be your abnormal loss. If you separate this from here, then you will get the cost of goods sold. And closing stock is of course 16,900. This is your closing stock, 230 units priced at this. Now, different methods will give you different results, obviously, because the technique is different. So this is your solution here. Now, same method using weighted average method. So weighted average method does not identify the lots, but they club everything. So this is your balance available. Now when you purchase, so herein you will be clubbing. So this stock in will be clubbed in this lot. So now you will be having 1500 units priced at 47,000. So you will simply club the quantity, you will club the cost, and this weighted average price will be calculated. So what it will be taken as 47,000, which is the total cost of the total quantity. Okay, 47,000, I'll write it here, 47,000 divided by 1500. So this way this weighted average price is arrived at. Now when you issue units here, now while issuing the units, you don't need to look at the lots. We don't have lots. So all the stock issue will be from the combined lot. So out of 1500 units, we will assume 600 are issued, 900 are left. So these will be priced as per the weighted average price. Then again you purchase a lot. Now lots are to be clubbed. So now you have 900 units here. This is the previous lot available. You purchased these 2000 units. So after clubbing of the two, you will be having 2900 units here with the combined cost. So you will calculate the two, and then weighted average price will be calculated as total cost divided by total quantity. So this will be your weighted average price. It is a revised price. Now when you have a shortage, it is not valued, but the cost is spread. What it implies is that out of 2900 units, 100 are lost. So it means your now quantity left is 2800, but the price remains same. So that way your price is revised again. So quantity is 28, it is reduced, but the cost remains same. So this price will be total cost upon total quantity. So you can make this column a little bigger and you can show the calculations here. Now next is issue. Issue is priced at the weighted average price. We have that price. So we'll simply assume that out of this total quantity of 2800, we have issued 900 units and we are left with remaining 1900 units. Right. Then you issued 1100 units again at the weighted average price. See, weighted average price remains same with every issue. But whenever you have a new purchase, your stock value will be updated. So when you purchase this, now you have again a total of the quantity to be recorded here. 800 was earlier there. Now club this information. So your quantity is 1100. Your cost is 30,914 plus this cost. Okay, so your total cost will be measured and accordingly weighted average price will be decided. So this weighted average price is not taken up with plus or minus something, but what is this is total cost present at this time divided by total quantity. This is your total cost and this is your total quantity. So cost upon quantity is your weighted average price. Now when you have loss by theft coming here, so this loss is to be valued since you have a weighted average price coming here. So this loss and the balance quantity will be measured at this. So you will assume that out of these 1100 units, You can say 700 are lost, and you are left with how many? You are left with 350 units at this price. All right. Now again another issue. So out of 350 units, we will assume 120 are issued, and we are left with 230 units. This is how this closing stock is adjusted, right? So this is your balance. You can total up the amounts again. This total that we are getting here is not cost of goods sold now. Previously in a simple question we used to say that this is cost of goods sold, but not now, because all this is not goods being sold. Out of this much amount is for abnormal loss. So if you subtract this amount, remaining will be your cost of goods sold. So this is how you will give your final answer. Now if in this question we are given selling price or sales, we can determine net profit also. And you can very well see here, closing stock is valued as per the rule, cost of goods sold is taken up, normal loss is nil, and your abnormal loss is measured.